Product Control, Derivatives Desk, Interview Preparation Guide. If you are preparing for derivatives desk roles in an investment bank, this video is built exactly for you. We have created very comprehensive interview preparation material specifically designed for derivatives desks at global investment banks. This is not surface-level theory. This is how derivatives are actually valued, risk-managed, and explained on the trading floor. In this session, you will learn how interviewers expect you to explain MTM, daily P&L, Greeks, volatility surfaces, correlation, IPV, model risk, and valuation adjustments, step by step. Do watch this video till the end. This level of preparation is exactly what differentiates strong derivatives candidates from average ones. Explain the end-to-end valuation workflow for a derivatives book, from trade capture to MTM, P&L, and IPV. The workflow begins the moment a trade is booked. Step 1. Trade capture. The trader enters the trade in the front office system. Every detail must be correct. Strike, expiry, payoff, notional, barriers, currency. If the booking is wrong, everything downstream breaks. Step 2. Market data sourcing. The pricing engine pulls prices, rates, volatilities, dividends, and correlation inputs. These must be clean, timely, and independently controlled. Step 3. Valuation and MTM. The pricing model, Black-Scholes, local vol, stochastic vol, or Monte Carlo, revalues every position at end of day. The difference between today's value and yesterday's value is unrealized P&L. Step 4. Daily P&L. You break the P&L into delta move, gamma move, Vega, Theta, and rho. You separate new deals, accruals, and valuation adjustments. Step 5. Independent price verification. Finance checks trader marks using independent curves, vol surfaces, and external sources. If trader marks deviate too far, you apply IPV reserves. This full loop ensures transparency and control every single day. Walk me through how the Greeks, delta, gamma, Vega, Theta, rho, influence daily MTM movements for an options portfolio. Each Greek measures one type of sensitivity, delta, price sensitivity. If delta is 50,000 and the underlying rises by $1, your option value rises roughly 50,000. Gamma, change of delta. Gamma amplifies movement. If gamma is high, small underlying moves cause large intraday P&L swings. Vega, volatility sensitivity. If implied volatility rises, long options gain value. If volatility falls, they lose value. Theta, time decay. Each day that passes erodes option value, especially short-dated options. Rho, interest rate sensitivity. Important for long-dated equity options and all FX options. Add them together, and you have your first-order P&L explanation. A trader questions your delta exposure numbers. How do you independently verify the calculation? Start with position confirmation. Make sure the trade economics match: strike, expiry, notional, and direction. Then calculate delta using your own valuation tool. Compare trader delta versus finance delta. Position level delta versus portfolio delta. Bucketed delta across expiries. If discrepancies exist, investigate. Market data differences. Model version mismatches. Incorrect notional or quantity. Stale volatility data. You respond with evidence, not assumptions. End. Describe how gamma affects intraday P&L volatility and how you would attribute unexplained swings. Gamma makes delta nonlinear. As spot moves, delta changes, sometimes sharply. Example, if gamma is 500 and the underlying moves $2, delta changes by roughly 1,000. If you hedge late or hedge imperfectly, intraday P&L becomes volatile. To explain unexplained swings, check actual versus expected delta changes, hedge execution levels, volatility intraday changes, barrier proximity effects, model recalibration. Gamma-driven noise is normal, but it must be quantified. What is cross-gamma, and how can it cause nonlinear P&L effects in multi-asset derivatives? Cross-gamma measures how the delta of one asset changes when another asset moves. Example, in a basket option, stock A's price affects the delta of stock B. So if both stocks move together, P&L becomes nonlinear. Cross-gamma introduces interaction terms that standard delta-gamma explains do not capture cleanly. You may see unexpected gains or losses when two underlyings move simultaneously. You isolate these effects through multi-factor sensitivity analysis. Explain how Vega risk is calculated and how changes in implied volatility impact MTM across exotic products. Vega measures sensitivity to implied volatility, not realized volatility. A simple example, if Vega is 200,000, a 1% rise in vol increases MTM by 2,000. For exotics, Vega is more complex. They may have forward Vega, sensitivity to future vol levels, skew or smile Vega, sensitivity to the shape of the vol surface, vol of vol exposure, sensitivity to volatility dynamics. So a simple 1-point move in vol may not explain the full P&L. You break Vega into pieces to attribute correctly. You observe a sudden spike in Theta losses for a structured options book. Walk through how you would investigate. First, determine whether Theta mathematically increased due to near expiry positions, barrier proximity, high gamma structures, auto-call dates approaching. Second, confirm no booking changes occurred. A new short-dated trade may create a large daily Theta. Third, check whether the vol surface shape changed. Sometimes, Theta appears larger because implied volatility dropped. Fourth, run component-level attribution to identify which products contributed most. Theta spikes are often logical, but the source must be clear. Describe the relationship between interest rate changes, ρ, and MTM for long-dated equity or FX options. ρ measures how option value changes when interest rates move. For long-dated options, higher interest rates increase the forward price of equities or FX. This increases call values and reduces put values. Example, if a 10-year ρ is 100,000, a 10 basis point rise in rates produces about 10,000 in P&L. In FX, both domestic and foreign rates matter. You must consider which side of the currency pair has shifted. How do you build a risk-based P&L explain using Greeks? You take yesterday's Greeks and you multiply them by today's market moves. Delta times price move. Gamma times 1/2 times price move squared. Vega times vol move. Theta times 1-day decay. Rho times rate move. This produces an expected P&L. You compare expected versus actual. The difference becomes unexplained P&L, which you must investigate. A disciplined P&L explain ensures transparency and trust. A barrier option shows MTM instability around spot. Explain what causes this and how you validate the model behavior. Barrier options behave sharply when spot approaches the barrier. Why? Because the probability of knockout or knock-in changes rapidly. As spot moves closer to the barrier, gamma and Vega can spike. This creates unstable MTM and unstable Greeks. To validate, test small spot bumps around the barrier. Ensure the model produces smooth results. Check whether hedging ratios behave logically. Compare with alternative models or analytic approximations. Instability is expected, but it must be mathematically correct. That's not fair. Explain the concept of local volatility versus stochastic volatility models and how model choice affects Greeks and NTM. Local volatility assumes volatility depends only on price and time. It fits the entire implied vol surface exactly, but it often understates volatility of volatility risk. Stochastic volatility assumes volatility itself is random. It captures vol-of-vol effects and skew dynamics better, but is harder to calibrate. Local vol tends to produce higher gamma, less Vega, more path sensitivity. Stochastic vol tends to produce smoother Greeks, better behavior for exotics, more realistic hedging implications. Model choice materially affects NTM and hedging stability. Describe how you validate volatility surfaces for vanilla and exotic options. You begin with data quality checks. Remove stale quotes. Remove crossed markets. Normalized bid-ask checks. Then construct the surface. Interpolate across strikes. Interpolate across maturities. Ensure smoothness conditions. You check for arbitrage violations, such as butterfly arbitrage, calendar arbitrage. For exotics, check forward vol consistency, skew stability, smile behavior under shocks. You compare with broker surfaces and exchange quoted levels. If differences are large, escalate. A skew shift occurs in the vol surface. How do you attribute its impact on P&L? A skew shift means the shape of the surface changed. Puts may have become more expensive, calls cheaper. To attribute, break Vega into parallel Vega, overall volatility level, skew Vega, slope changes, smile Vega, curvature changes. Then multiply each Vega by the corresponding vol surface movement. This gives a clean view of how skew contributed to P&L. What is a correlation surface? Explain how correlation changes impact multi-asset option NTM. A correlation surface describes correlation levels across maturities and strike equivalent structures. Multi-asset derivatives, such as basket options, worst of options, or spread auctions, depend heavily on correlation. Higher correlation makes assets move together, reducing the diversification effect. This usually reduces the value of worst of options. Lower correlation increases valuation uncertainty and tends to make worst of options more expensive. Correlation changes therefore create large MTM swings, even when spot prices do not move. Walk me through the independent price verification IPV process for derivatives. IPV ensures trader marks are fair and consistent with market levels. You collect external quotes, broker surfaces, consensus data, market trades, benchmark curves. Then compare them to trader marks. You calculate deviations. If deviations exceed defined tolerances, you adjust marks and record an IPV reserve. IPV is independent, conservative, and documented. Its purpose is to prevent valuation bias. How do you determine IPV reserves for volatility, correlation, dividends, or interest rates? You measure uncertainty. For volatility, compare trader vols with independent surfaces. If the trader is marking too optimistically, apply a reserve equal to part of the difference. For correlation, use broker levels or model implied correlations. If correlation is unobservable, especially long-dated, reserve more. For dividends and interest rates, compare against futures implied expectations or broker forecasts. Apply reserves where inputs are stale or uncertain. The reserve reflects the amount of valuation uncertainty that cannot be priced precisely. Describe the types of valuation adjustments, CVA, DVA, FVA, KVA relevant to derivatives, and how they impact NTM. CVA, Counterparty credit risk. If the counterparty becomes riskier, NTM decreases. DVA, your own default risk. If your own credit weakens, derivative liabilities may fall, creating gains. FVA, funding valuation adjustment, reflects cost of financing hedges. KVA, capital valuation adjustment, reflects regulatory capital costs. These adjustments alter MTM even when market risk factors don't move. Product control explains them separately as valuation adjustment P&L. A model calibration changes overnight. Explain how you isolate the P&L impact attributable solely to model risk. Revalue yesterday's positions using yesterday's calibration, today's calibration. Hold market data constant, hold positions constant. The difference between the two valuations is the model risk P&L. This isolates the effect of calibration updates and prevents contamination with market moves. How do you validate inputs such as forward curves, discount factors, and dividend assumptions used in derivatives pricing? You validate by checking consistency across systems, alignment with market levels, arbitrage-free construction, reasonable interpolation. For forward curves, check that forwards match futures prices and spot plus carry logic. For discount factors, ensure they align with OIS curves and swap quotes. For dividends, compare against futures implied dividend levels and broker estimates. If assumptions deviate from market, you challenge them. Explain how to verify MTM for illiquid or bespoke exotic derivatives when there are no observable market quotes. You use model-based triangulation. Break the exotic into simpler building blocks, vanillas, barriers, digitals, and value each independently. Use alternative models, historical relationships, proxy vol surfaces, scenario analysis, backtesting against similar trades. Apply liquidity and model reserves to reflect uncertainty. Document every assumption clearly. This protects you during audits. A discrepancy appears between front office MTM and risk system MTM. Walk through the reconciliation steps. Start with structure, not assumptions. First, confirm the position set. Are both systems valuing the same trades? A missing trade or a stale cancellation often explains most MTM mismatches. Second, compare market data. Spot price, implied vol surface, interest rate curves, dividend or forward assumptions, correlation inputs. Even tiny differences in these inputs can create large MTM deviations. Third, verify model versions. Different pricing engines, Scholes versus local vol, or Monte Carlo version 1 versus version 2, will never match. Fourth, perform a component-level valuation check. Take a single trade and revalue it in both systems with controlled inputs. This tells you where the discrepancy originates. Finally, document and escalate. Your explanation must be clear enough for senior management to trust and repeatable for audit. Describe how to challenge trader marks using alternative models, external data, or broker quotes. Start by collecting independent data, broker quotes, consensus surfaces, trace prints, or exchange quoted levels. Then build your own valuation using independent models. For example, Scholes, a local vol adjustment, a stochastic vol model, a simplified Monte Carlo. Compare your independently derived MTM range with the trader's mark. If their mark is outside that range, you present your assumptions, your inputs, your valuation range, your justification. You challenge respectfully, but firmly, because product control's role is independence. Explain the concept of Day 1 P&L and when it must be deferred under accounting rules. Day 1 P&L is the difference between the model's fair value and the actual traded price on the day of execution. If all inputs to the model are observable, for example, quoted volatilities, quoted rates, or quoted forwards, Day 1 P&L can be recognized immediately. But if some inputs are unobservable, such as long-dated correlation, forward skew, or vol-of-vol assumptions, then accounting rules require deferral. The deferral is released over time as uncertainty reduces or as risk runs off. This prevents overstating profits on complex, illiquid trades. You notice large unexplained P&L, UEP, due to volatility. What checks do you run to identify the issue? Start with volatility source reconciliation. Check whether the trader used intraday vol, while finance used end-of-day vol. Then check surface construction. Were ATM vols updated correctly? Were skew or smile buckets stale? Did interpolation create anomalies? Next, verify Vega sensitivities. If Vega is wrong, even a correct vol move produces incorrect P&L explain. Then test parameter consistency, dividends, forwards, interest rates. Finally, isolate one trade, apply controlled vol shocks, and match expected versus actual valuation. This reveals whether the issue is data-driven, model-driven, or booking-driven. How do you evaluate whether hedges are effective? By analyzing Greeks-based hedge slippage. Hedge slippage is the gap between expected P&L and realized P&L. To evaluate effectiveness, compare delta hedges traded versus delta predicted by the model. Measure P&L impacts of gamma, especially after sharp moves. Analyze Vega slippage. Did implied volatility move differently from expectations? Examine execution prices. Slippage often comes from execution cost or timing. Effective hedging means realized P&L roughly matches the risk-based explain. If not, you identify the driver, timing, model limitations, liquidity, or trader strategy. Describe how to perform sensitivity analysis on Greeks to identify unstable or incorrectly calibrated models. Start with small bumps in each input: spot, vol, rates, dividends, correlation. If Greeks jump disproportionately, the model may be unstable. Next, test larger bumps. Greeks should scale smoothly. If gamma flips sign or Vega explodes, calibration may be broken. Then, test grid stability. Change the number of simulation paths or time steps. Values should converge. If not, numerical instability exists. Finally, compare Greeks across adjacent strikes and maturities. They should be smooth, not jagged. This structured analysis highlights calibration issues before they create P&L noise. Explain NTM differences between Black-Scholes, local vol, and stochastic vol models for exotic options. Black-Scholes uses a constant volatility. It captures ATM levels but ignores skew. Exotics priced with Black-Scholes often misrepresent Vega and barrier risk. Local volatility fits the full implied vol surface exactly. It often produces higher gamma, lower Vega, stronger path dependency. It tends to underprice products with strong vol-of-vol exposure. Stochastic volatility models volatility as random. These models capture skew dynamics, smile evolution, and vol-of-vol risk. They generate more realistic MTM for exotics like barriers, autocalls, and clickets. Model choice significantly changes MTM, Greeks, and hedge quality. Walk me through the risk factors that drive MTM for a cross-currency option and how to separate them in P&L explain. A cross-currency option depends on multiple variables: spot FX rate, domestic and foreign interest rates, implied volatility surface for both currencies. Correlation between FX and rate moves. To build a clean P&L explain, delta explains spot FX impacts. Rho explains interest rate impacts from both currencies. Vega explains vol level and skew impacts. Cross-Greeks explain interactions, such as rate FX correlation. By isolating each component, you create a clear narrative even for complex products. A desk trades an autocallable note. Explain the embedded risks, delta, Vega, correlation, barrier risk, and their P&L impact. Autocallables are path-dependent, multi-risk instruments. Their main risks include delta. The product behaves like a long equity position with embedded optionality. Delta changes rapidly near autocall dates. Vega. Autocall probability heavily depends on implied volatility. Lower vol increases autocall probability, reducing the value of long autocallable positions. Correlation. Basket autocallables depend on how underlying assets move together. Lower correlation increases worst of outcomes. Barrier risk. If barriers are near spot, gamma becomes large and P&L becomes jumpy. Daily MTM must attribute each effect separately. How do you validate pricing for path-dependent instruments such as Asian options, barriers, or digitals? You validate through multiple angles. Compare with analytic benchmarks where possible. Use alternative models, for example, Monte Carlo versus finite difference. Test sensitivity stability. Bumps should produce smooth Greeks. Perform path-level diagnostics. Does the model simulate reality correctly? Backtest against historical scenarios. If pricing is highly sensitive to time steps or simulation paths, calibration requires tightening. Describe how scenario analysis is used to challenge trader valuations and Greeks. Scenario analysis simulates what-if market conditions. You apply shocks, spot up or down, volatility up or down, correlation shifts, rate shifts, forward changes. Then observe how the model behaves. If the trader's Greeks cannot reproduce scenario P&L, their numbers may be unreliable. Scenario analysis exposes hidden risks, such as vol-of-vol exposure, forward skew, or barrier sensitivity. End. A misbooked trade results in incorrect risk metrics. Explain how you identify and quantify the impact on MTM. You see mismatched delta or Vega movements. That is your first clue. Then you inspect the booking, strike, expiry, barrier direction, notional, payoff type. Once corrected, you revalue the trade using the correct economics. The difference between old MTM and corrected MTM becomes the booking correction P&L. You must document. Root cause P&L impact, controls to prevent recurrence. End. What tests do you perform to validate numerical stability in Monte Carlo pricing models? Several core tests. Convergence tests. Increase number of paths. MTN should stabilize. Time step tests. Refine time layers. Valuation should not oscillate. Variance reduction tests. Techniques like antithetic sampling should reduce noise. Path diagnostics. Simulated paths should reflect correct drift and volatility. Consistency checks. Black-Scholes should emerge as a special case with constant volatility. If the model fails any of these tests, numerical risk is high. Explain how Greeks behave near expiry for deep ITM, deep OTM, and at-the-money options, and why this matters in daily P&L. Near expiry, Greeks become extreme. Deep in-the-money options, delta approaches 1 for calls, and -1 for puts. Gamma shrinks. Deep out-of-the-money options, delta approaches 0. Gamma shrinks. At-the-money options, gamma becomes very high. Delta becomes extremely sensitive to spot changes. Theta becomes very steep. This matters because small market moves near expiry produce disproportionate P&L swings. Your explain must incorporate this sensitivity. You see a jump in MTM without any corresponding market movement. List the possible causes and your investigation approach. Possible causes include incorrect booking, model recalibration, curve roll or surface roll, parameter shifts, dividends, funding, correlation. Settlement or cash flow adjustments, system version changes, trade feed corrections, data source failures. To investigate, revalue yesterday's book using today's inputs, and today's book using yesterday's inputs. This isolates booking changes, market changes, model changes, data changes. UEP must be resolved before sign-off. How do you review and approve new models or products before they go live on the derivatives desk? This is the new product approval workflow. You check payoff documentation, model theory, calibration approach, numerical robustness, sensitivity behavior, benchmark comparisons, stress testing behavior, IPV requirements, hedgeability and risk metrics. Then perform end-to-end booking tests, from trade capture to P&L. Approval requires sign-off from model validation, risk, product control, legal, and finance. Explain how liquidity, bid-ask spreads, and stale data impact IPV outcomes. Illiquid markets create wide bid-ask spreads, meaning fair value sits somewhere within a range. The wider the range, the larger the uncertainty. Stale data, for example, a vol quote from 3 hours ago, may misrepresent reality. This causes trader marks to deviate from true market levels. As uncertainty increases, IPV reserves must increase to protect the firm from valuation risk. A new trade introduces correlation and volatility of volatility exposure. How do you incorporate these into the risk reporting framework? You expand the sensitivity set. Add correlation delta, sensitivity to correlation shifts. Correlation gamma, second-order correlation effects. Vol Vega, sensitivity to volatility of volatility parameters. Skew Vega, sensitivity to slope of implied vol surface. You run scenario analysis to show management how these risks behave under stress. You update reporting templates so every risk factor gets daily visibility. Describe how you produce a P&L. Explain that separates market movements, new trades, model changes, and IPV adjustments. You structure the explain in 4 clean steps. Step 1. Market-driven explain. Delta, gamma, vega, theta, and rho effects. Step 2. New deals and trade lifecycle effects. Trade bookings, amendments, expiries, and settlements. Step 3. Model-driven effects. Calibration changes, numerical updates, new versions. Step 4. Valuation adjustments. CVA, DVA, FVA, KVA, and IPV reserves. Present these in a simple, defensible narrative. Clarity builds trust with senior stakeholders. Give an example of a time, real or hypothetical, where you challenged trader marks or Greeks and how you justified your position using independent valuation techniques. Here's a clean hypothetical. A trader marks a long-dated barrier option using a very low implied volatility, which produces a favorable MTM. You compare this volatility with independent surfaces and see the trader is 3 vol points below market. You run a local vol model, a stochastic vol model, a Monte Carlo using independent inputs. All models price the barrier option materially lower in value. You show the trader external broker quotes, your valuation range, Vega sensitivities, the impact of correct skew assumptions. Management supports your independent adjustment. This is what product control does best. Protect the firm using transparent, data-driven techniques. Derivatives are not just about formulas. They are about understanding risk, behavior, and valuation under uncertainty. This was a deep, end-to-end interview preparation session created especially for derivatives desk roles in investment banks. If you followed this entire video, you now know how to explain MTM movements, defend Greeks, challenge trader marks, and separate market risk from model risk. Exactly the way interviewers expect. Rewatch key sections, pause, and practice explaining them aloud, because clarity, structure, and confidence are what get you hired. For more in-depth, role-specific interview preparation for trading, derivatives, and risk roles, stay connected. And once again, do watch, revise, and master this material.